Next session is basically around credit enhanced structures. And whether you think about credit enhanced structures as guarantees or interest subvention, these are basically tools used by larger institutional capital providers to support large scale capital for impact. So we do have another round of panel which will be discussing credit enhanced structures now. And this session is moderated by Tushar, associate partner at Dalberg. Welcome, Tushar. Joining. Hi, Roopa. Country Head of Sustainable Banking and CSR at IndusInd Bank. Joining Tushar and Roopa, we have Priya Naik, founder and CEO, Samhita Social Ventures. Please sit. We also have Apoorv Shukla, Development Finance Specialist at USAID, and Ravi Vukkadala, CEO at Northern Arc Investments, joining this panel. Hi, Ravi, welcome. Welcome, panelists. And Tushar, over to you. And looking for a lovely discussion on credit enhanced structures, please.
Excited because we have panelists to represent the whole gamut of actors across the investing ecosystem. We have Apoorv, who represents a large donor. We have, of course, Priya and Ravi, who are practitioners, and Priya, of course, has set up a really interesting blended finance facility, which we'll talk more about, and Roopa, who represents a large bank, which is an interesting pool of capital, which has just begun evaluating and experimenting with blended finance. We will dive straight into some of the questions that I have. For a brief context, I think as Pragya mentioned, we'll talk about credit enhanced structures, which essentially are usually financial, but often also non-financial mechanisms, which are utilized to reduce risk perception for individuals, organizations, communities, ecosystems, etc., to divert capital towards areas of need. Compared to the previous panel, this is one area which actually has seen substantial government participation in the past as well. They continue to utilize guarantee mechanisms or credit enhancement structures to catalyze capital towards particular areas, and we'll explore some of that. I think we'll basically get into a couple of themes. One will be primarily around understanding the work that each of our panelists are doing, but also to get a sense of what are some of the innovations, some of the practices that they're seeing as well. And then we'll go into this problem of scale. While, of course, these structures have been around for some time, we haven't really seen this catalyze the amount of capital that we would like them to. So we'll talk about why those might not have scaled so far, what might be opportunities, and what might be the areas that we could really dive into. So that's broadly the background from which we'll start, and maybe diving straight into the experience of the panelists. I'll start maybe with Apoorv. We do have a mic there. Apoorv, I think USAID and US government entities have been pioneers in setting up a number of these structures and facilities, credit enhancement facilities. Can you talk about some of the work that you've done? Have you actually seen some of the impact that you set out to do when these facilities were set up?
Yeah, thanks a lot, Tushar. And I think Abha said, it's going to be tough to follow up with an interesting session after lunch, but I think it's going to be tougher to follow up after that one. And I'm hoping Priya, Ravi, and Roopa can be controversial, because I will not be, to keep it interesting for you all. So, in terms of what we as USA do to build some of these credit enhanced products, let me talk about three broad types of instruments we've used, and the third one I'm only adding pay for success because there was so much discussion around that distinction. The first one is an instrument USAID has used for many decades now. It's the partial pari passu credit guarantee structure, where the idea is that we work with local private financial institutions to, through the use of a guarantee, help them essentially dip their feet in certain underserved development sectors that USAID is obviously interested in. And the idea is to provide this guarantee over a smallish portfolio, so that it helps them build a long-term business model after they understand the risks. The idea is really to separate the perceived and the real risk for the financial institutions. Currently, we have I think 15 such partnerships spread across all of the sectors that we're in: healthcare, water, sanitation, clean energy and climate, sustainable landscapes, agri, education. And we mobilized over $500 million. I mean, right now the facility size sums up to around $500 million. So that's one kind of instrument we use. Second one, and I think it's been talked about quite a bit since the morning, are these really pooled grant facilities where the grants can be used in a flexible way. Depending on the needs of the entrepreneurs and the lenders, right? So, Samrit is one example. Revive is another example where this grant can be flexibly used. Say for example, for an enterprise that finds the cost of capital too high, right? This grant pool can be used in a social success note kind of a format. If again the issue is of a high perceived risk or even a high real risk, we could use these grants flexibly through a first loss or a partial guarantee. So that's really the second kind. The third one, and the reason I want to touch upon it, is this pay for success. So social success notes where you link interest subsidy to certain predefined outcomes being met is obviously something we've done through Samrit, through Revive and others. But now we are starting to think about using development impact bonds also as a tool to do two things. One, provide a proof of concept for enterprise-based models for lenders to come in, and secondly, also as bridge financing, like use development impact bond to serve as bridge finance to an enterprise-based or sets of enterprise-based models, and keeping the risk investor involved right from the beginning so that they start understanding that space and are able to scale lending in that area. On your second question around the impact. I think we've heard quite a bit already on Samrit, for example. I think Himanshu spoke about 35 solutions that have been supported in the last 15 months. Every week I get an update from him. It's 5 more solutions added. They've reached around 25 million people. That facility has leveraged $300 million over a 35 million grant that was put in by USAID and other donors. Revive, I'll let Priya talk about. And I think on the guarantee side also, over the past many years, with the partial pari passu guarantee structure that we work with different NBFCs and banks, we've seen success in terms of them being able to lend to same sets of enterprises outside the guarantee once they've lent to them once under the guarantee, because now they understand the business models much better, and similarly been able to scale up, lending in that space. And Roopa is here. We have a partnership, pretty huge partnership with her on health and wash side. So maybe she can throw some more light on that.
Thanks, Apoorv. I think you spoke a lot about the number of sectors and the number of stakeholders that you engage with. So really exciting to see a lot of the impact that you're driving. I think the leverage question had come up in previous panels as well, and fairly significant leverage on some of the activities that you mentioned. I will actually maybe go to Roopa next, since you mentioned the partnerships with her. Roopa, you've been you've been one of the pioneers. The IndusInd Bank has been one of the pioneers in actually participating in these kinds of structures, but also really pushing forward and trying to come up with these partnerships and platforms. Do you see these kinds of structures, which are backed by credit enhancements and sort of associated financial approaches, as being the pathway to maybe bring in the broader commercial banking sector as well? So if you could talk about your experience first, and maybe then talk about how the pool can potentially be expanded to really bring about alignment in how capital is utilized.
Sure. Thanks for having me here. So about my own experience, I've actually spent about 30 years in corporate banking. Recently shifted into sustainable banking as a career option. Over the last 5-7 years, actually, the shift has been very gradual as we started embedding ESG into corporate banking itself. Now, over the last 2 years, I manage sustainable banking in IndusInd, which spans across corporate and retail. So yes, I think a blended finance, which essentially for me, they talked about multiple pillars and all that. I didn't know the definition, but for me, blended finance there's only one word that defines it, which is partnership. and that has been the crux. And I think that's the if you fix that partnership, who are the people coming together, that's the biggest challenge, and that's the biggest opportunity, I think, for solving the issue. I think we have done several structures and several deals, right from partnerships with DFIs, partnerships with private equity players, NBFC, impact NBFCs, Government of India, foundations, very strong partnership, DFC, USAID, Dell Foundation, GOI for several, NSDC also actually. And I think in terms of structures also, right from the very basic pari passu risk guarantees to subordinated and senior debt structures, partial guarantees, FLDGs, just partnerships for reducing the cost of funds to the borrower. So a costlier financier and a cheaper bank finance coming together and working out a solution for the borrower. Then combining a grant plus the loan from the bank. So many of these things, even in fact using retail financing. Last year we launched a green deposit. I was surprised at the amount of interest that retail investors have in green, because we raised close to 10,000 crores in just 3 months. So it was phenomenal, the impact, the response. So I think I think it's a very challenging space, because the kind of the learnings from all those experiences, I feel, has been that it takes time to build momentum. So you need that patience. Patience either has to come from passion and emotion, like the last speaker here said, or it has to come from just having a longer term horizon. If you are in a commercial bank which has a quarterly target and stock price that you have to be very conscious about, you can spend only that much time structuring all this pay for performance bonds and all that. You've got to complete your deal for the quarter, so you just don't have that much time. So I think it requires a lot of patience, it requires passion, it requires like-minded people and partners coming together, and the sectors that you choose. If you choose sectors which are not scalable for banking solutions, despite all of this being there, you will never be able to put out money. And there are some sectoral challenges in India, because if it is unorganized and if it doesn't lend itself properly to bank finance, no matter how much you try, whether you blame the bank, you blame the foundation, or you blame the structure that you have created, platform banao, chahe jo bhi karo, the underlying borrower has to be credit worthy. So there are some sectors which lend itself to that, some don't, and so that you've got to be careful that when you do that, so that it's sustained. More later.
No, wonderful. Thank you, Roopa. And I think the 3 P's of patience, passion, and sorry, there was one more P I thought of which I forgot now. But essentially seem to be the ones which we are hearing from everyone. It does take time. It needs and partnership. Sorry, of course. It needs time. It needs everyone to be engaged for a longer period, and therefore I think the group that we have here are all investing to hopefully set this up for the future. And then maybe moving on to an example of how this has been implemented. Well, everyone's talking about the Revive Alliance that you set up, Priya, and what we would like to learn. I think there's a lot to learn from there, but when we talk specifically about credit enhancements and the role that they play, how have those supported the Alliance in actually structurally transforming how you think about credit worthiness, how you think about informality or formality when it comes to lending?
Because Apoorv said I have to be controversial, I will be. So let me take off from where Roopa kind of left, right? So 2 years ago, we were responding to the crisis. And we said, there's all of these millions of workers and micro entrepreneurs who've largely been informal, who, like Roopa said, banks or NBFCs never believed that they're creditworthy. So actually, since everyone's referred to Abhinav, but really, I think, we co-created the returnable grant with Abhinav and Rahir from MSDF. It was really a simple principle. If you give money to somebody, and if you say zero interest, zero collateral, pay if you can, pay when you can, what happens, right? What happens in the middle of a pandemic to somebody whose life has been destroyed over and over and over again? So I'd like what do you think happens when you give money to people in the middle of a pandemic? Do you see 10% defaults, 50% defaults, 80% defaults? What do you think? High, right? So we had 3% defaults, right? 97% repayment rates, 100% from farmers, 100% from retailers, low repayment rates from Bano, right, who Prachi talked about, who's a beauty entrepreneur. And why did Bano have a low repayment rate? Because she had a business that shut down many, many, many times. And so what we did is we gave money to lots of people, street vendors, farmers, artisans, and we said, what happens when people who we don't believe are credit-worthy are actually given the credit? And no one's knocking on their door, no one's giving, there are no threats being made, right? You see 97% repayment rates. So where are we going with this? So Revive started out, I remember when Abhinav and Bharat first set it up, we said 30 crores, maybe 30,000 people. Then USAID came in and we said maybe 60,000 people. Then we said maybe 200,000 people. And now we're saying, can we irreversibly increase incomes of 10 million workers and micro entrepreneurs, right? So the scale has come purely because of partnerships. And the thesis is very simple. Entrepreneurs and workers need 6 things. They need access to capital, and capital has to meet them where they are, right? So somebody gets a grant, somebody else gets a returnable grant, somebody else gets a low-cost loan, but you have to significantly move them to the right. You can't keep getting a returnable grant. If you've got a returnable grant, you move to low-cost debt, then you move to regular debt. So graduation is important, but access to capital is vital. If you have no money, you're not going to be able to scale your business. Digital transformation was very, very critical. Think about your vegetable vendors, right? Or your Kirana store. If they weren't able to take your orders on WhatsApp, if they weren't accepting Google payments, that business was over. So digital transformation is vital. Government social security schemes, a vast number of people we work with are eligible for all kinds of schemes, have never heard of it, don't know how to fill up paperwork. Trade-specific skills, right? When you help a Kirana store is a Kirana store is a Kirana store, right? Today we work with 85,000 Kirana stores. And so we realized instead of trying to do specific trades, take trades where you're seeing sectors where rapid job and entrepreneurship creation is happening. You offer trade-specific skills, they grow systematically. Build in market linkages, don't have customers, you don't grow the business, right? Provide enterprise development support. A large number of women that we were working with, while they had 97% repayment, would never qualify for bank financing because they didn't file taxes, they didn't know how to do accounting. So what we're doing is bringing every single intervention together, because one intervention now and then doesn't help, right? Just bring it all in, sequence it, bundle it, whatever makes sense, and do it at scale systematically. I just want to spend a couple of minutes on something that we're doing, which I think is very critical. So when we did the returnable grants, we said, hey, wait a minute, all of you banks and NBFCs, why don't you lend to this person? And they said, but we follow the CIBIL score, and the CIBIL score, none of them have a CIBIL score. None of them have the paperwork that's required. So we are beginning to co-create a pre-credit score. And this is happening with CIBIL and with banks and with NBFCs to say, what data can you provide? What data can I provide on this individual that replaces a lot of the documents that you asked for because they don't have those documents? So somebody gets a returnable grant, they pay it back, you co-create a pre-credit score. We're talking about putting together a credit guarantee. It's available only during the first loan. Take the loan, pay it back. The individual knows how to take a loan, pay it back. The NBFC is convinced, continue to support them. The person goes from NBFC to bank financing, right? So the intent is, what is the smallest amount of capital that you can use to move people from the left to the right in the fastest amount of time. We're not a MFI, we're not an NBFC, but we work with many, many NBFCs, right? And in my mind, success is when my RG person starts borrowing from Roopa, and Roopa does not have to compromise on her risk assessment criteria because banks are not going to. And so what can I do to build trust, right, from that woman, street vendor, to her being able to borrow? So sort of building out this continuum of capital and doing it with MFIs, with NBFCs, with USAID, with MSDF, with large companies. I mean, for us, I think one of the advantages, because, I run a CSR business, is we know lots of companies. Now, companies care about the same individuals. Godrej cares about these beautypreneurs because they buy products, and Unilever and P&G care about the Kirana stores because they buy their products, and everyone's sourcing from the farmers. So what we're doing is we're saying philanthropic money, only catalytic, right? How much leverage can philanthropic money unlock from the government, from the private sector, and from financial markets? So just to give you a number, the first grant that Abhinav gave us, we're now at 87x of the money that he gave us, right? That will go, that'll increase. The first grant that Bharat gave us, I don't think he's here, 58x leverage, right? And all of this has happened in the last 2 years. I don't think any of us expected these numbers in terms of leverage. And the very last thing is, I know, Abha, you talked about income. You talked about impact and, how do you get everyone? And today we have 21 impact partners, 27 funders, 50 odd participant profiles. And the only thing that mattered was income. And so we said, if the poor care about increasing incomes irreversibly, that's the income that all of us will hold ourselves accountable to, right? All of this reach and, maybe placement doesn't cut it. All they care about is money in their hands year after year, and that money has to grow. It has to be above inflation levels. So we're all committing ourselves to that one metric of success that is as important to the individual we look to support as is for all of the stakeholders that we work with.
Wonderful. Thank you. Thank you very much, Priya, for sharing that. Some amazing numbers there, and the leverage that you spoke about, I'm assuming continues to grow because this is also a period of time, and not just about, this probably at this point of time. So really exciting to see traction, exciting to see size and scale coming up in that. I'll come back to Roopa and maybe pick on some of the themes that you spoke about, but maybe I'll go to Ravi first. And thanks, Ravi, for joining. And, you operate in a much larger segment. You direct capital towards enterprises, and then you have a pretty strong sense of how small enterprises need some of the support to be able to achieve financial inclusion, to be able to grow. How do you see these structures helping you achieve some of those objectives, and how, as someone who's participated in structured and created a number of these funds and transactions, what sort of innovation, what sort of ideas are you seeing emerging in the space?
Sure, thanks, Tushar. So thanks for everybody to join into the panel. And it's a little bit of a yes and no answer to your question. I think Apoorv and Roopa provide the yes part. Priya to some degree has provided the no part. And I'll elaborate on that. So there has been a lot of capital, and we've spoken about partnerships, we've spoken about structures, they're standardized. Credit enhancement is something that almost every provider of capital in India today is well versed with, right? But if you put a bunch of practitioners on a panel, then obviously all the answers will be yes. If I put a mutual fund guy, if I put an insurance guy, they'll be saying that I have not invested in most of these things, right? So there is a lot of capital in the country, and we've touched a fair amount of it. But in terms of needs, everybody knows India's need is huge. There is a lot of capital. Direction is the problem, right? So just as an introduction, I work with Northern Arc. Over the last decade plus time that we've had here, we've arranged or structured credit enhancements worth 50,000 plus crores out of a total 1 lakh crores of financing, right? And we've only provided about 20% of that. Now, that shows that there is a huge amount of capital available, right? Because banks are providing, NBFCs are providing, DFIs are providing, overseas investors are providing. There are a lot of takers of capital. Obviously, there's a large part of the country which has come into the fold of financial inclusion, especially with higher credit scores, right? But the kind of provision of capital is still hugely skewed towards the one who don't want to take risk, right? So partnerships are there, banks are there, obviously DFIs are there, foundations are there, but they all want to take the senior tranche. Right? So today, a mutual fund industry has 37 lakh crores of assets under management. Insurance has 40 lakh crores. NBFCs have 30 lakh crores. Banks have over 100 lakh crores. And over the last 10 years, Northern Arc has done about 1 lakh crores. Right? So and we count ourselves as having achieved a huge amount, right? During guarantees, securitization, which is now a standard structure, PTC, first loss, second loss, partial guarantee schemes, a pooled loan issuance, a pooled bond issuance. On an AIF, we have senior junior tranches. Today, across NBFCs, there is a co-lending structure, which is also in some way FLDG and co-investment, right? Where the ones who's originating the loan is on taking the risk. So a lot of the risk capital has come from the main principal who's originating these loans. The ones who's closest to these borrowers, as Priya mentioned, right? They are the ones who are taking this risk, not a lot of the others. Right? So there is a huge paucity, and I would say that the degree of innovation is directly related to the paucity of capital. Right? So there were a lot of innovations earlier, but now financial inclusion has become a little more mainstream. There are listed microfinance companies on the market. Everybody's lending quite easily to microfinance companies. As there was one undiscovered segment earlier, which was lending largely to the women borrowers. But these other development outcomes, right? And if you look at the panel before and some of the cases that were mentioned, there is not as much innovation happening there. I mean, this is a rare spark that during the pandemic, Priya managed to get the alliance going, and you got financing, but it is not mainstream. It's not like a Parle-G biscuit that now everybody's subscribing to that. So that's where a lot of the gap is. So huge amount of money has happened so far. Huge amount of capital is available. Some structures have mainstream, but there is a need for a lot more innovation, which frankly is not being looked at very positively by the regulator. Right? If you look at the digital lending guidelines, if you look at some of the structures they've gone against, it's still stick to the standard, and this is going good so far. So.
Okay, thanks a lot, Ravi. Maybe coming back to Roopa, and there are a couple of things that I would pick up from what Priya said and what Ravi said. And
Now the fight starts.
and get your perspective. I think you're one of the converts. You're one of those who's actually made the transition, taken some hard calls, and actually begun participating a lot more. Just to maybe pick on a couple of threads. I think based on what Priya said was. They've figured out, while of course, this is early stage, it's growing, but they figured out a way in which they can get individuals from the unbanked informal to potentially formal. However, I think the next step now is for banks or commercial banks, mainstream commercial banks to actually take them on, or even NBFCs to take them on and continue to provide financial inclusion. And Ravi spoke about innovation in certain spaces, but not so much in others, and therefore, are we sort of stagnating? I think, if I interpret that right, as being one of the challenges. Do you see, you've already taken some of these steps, but do you see, or what do you see might be some of the prerequisites for the remaining or the larger banking sector to actually do some of these things? Do you think some of these initiatives can actually help in scaling or helping the banking sector understand what it might take to direct more capital towards these kinds of developmental outcomes?
Right. So, I feel that the structure of the market, the way it is today. So you have the poor bottom of the pyramid, and there is a financing structure which is evolved there, which suits large players, and lots of money has come in there, and that is transformed. Now, automatically, the next level, we are having a problem there because the structure and that went through a lot of crisis before it stabilized, right? There was a lot of problem there. And then it stabilized and it found solutions with regulators coming in, with financiers taking some losses, etc. Now, the next step is for the transition, what the markets that everybody has been referring to, which is the MSME market, or not the very rural poor, but maybe some urban poor, and maybe this very small traders, kirana stores. There are lending models emerging there, where proper commercial banks and financiers and NBFCs are financing. It's not as though it's not there. There are a lot of NBFCs which play in that segment. Now, it will and banks can't play very actively in that segment. We do some amount of that through our microfinance arm, but banks can't play because that reach is not there, and the cost structure of the bank doesn't enable them to play in that. That is why NBFCs are there. So Reserve Bank of India is saying, and by Northern Arc perhaps feels. So what Reserve Bank of India is saying is that you have different players with different niches that they are occupying. Please be present in that niche and do जो वहाँ पे करना है. Please focus on doing that job. So if a bank is trying to get into that market, which is a higher risk market, it will be penalized by Reserve Bank of India. It will not be encouraged because the bank does not have the necessary monitoring mechanisms, the understanding of risk, the distribution of credit. It has to rely on a certain assessment of risk in a certain methodical manner where models are there. And this segment does not lend itself to that financial modeling. So I don't think it would cause chaos if everybody went here and there trying to do what everybody. So the same way with foundations, I would say. So my quarrel with foundations is that while good amount of money is coming in, people are extremely focused on what we are calling impact or social objective. I mean, so it becomes very difficult for a scalable institution like a bank to sit down and finance something scalable or structure something scalable, because if you start splitting everything into this sector, that particular impact metrics, etc., for a bank, banks are not organized like that, right? You have the large, so if you look at sectors, then you can work out something for sectors which provide scale, which is like renewable and environmentally positive. Somebody mentioned electric vehicles. I'm sure we are already dabbling in it, but I'm sure it will come through. Or it will be retail, because in retail you can get those structures going. If you have to finance the MSME and then you have to start creating structures, it does not work there, because each deal is extremely difficult to finance. There has to be a standard way of assessing the risk, calculating the risk, measuring it, pricing it, and moving forward. And there are models in the banks to do that, which is time tested and with default rates. And I mean, I get where Priya is coming from. It's fantastic that, the default rate has not yet, but what do they say? One swallow doesn't make a spring come, or whatever it is, right? I mean, it has to be time tested for commercial banks to adapt. It's great. So many more Priyas in the country doing many more such things till it becomes, that's how the microfinance industry came up. And it is where it is today, right? So that is what, when we talk scale, we talk that as scale. That will only solve problems, according to me.
Yeah, I was actually going to come to you, Priya.
So I fully agree, right? The one thing I learned in the development sector is this notion of could have, should have, there should not be any poverty, there should be world peace. I think very quickly I realized that ain't going to happen, right? So the one thing that I think we are beginning to do well is to meet people where they are. I do not expect IndusInd's or any other bank's credit risk assessment policy to change. Now the question is, what can I do, knowing where Roopa can begin, what to come as closely to her beginning as possible, right? So I feel like the one thing that we figured out in the last 2 years is, how do you respond to the needs of many, many actors? I remember when we first set up Revive with MSTF and Omidyar, it was supposed to be a returnable grant facility. And then USAID came in and we said, well, love the RG, but can't do the RG. And so I think with USAID's money, we were very creative. We did pay for performance, we did interest subvention, we did all kinds of stuff. Then FCDO and UNDP came in, and FCDO said we will only do infrastructure, and UNDP said we will only do sanitation. We said we shall do that too. And suddenly what was a standard instrument became a blended finance facility, which means use every instrument in whatever is available. CSR, you can do grant, let's do grants. Whoever can do returnable grants, let's do returnable grants. Wherever I can get into subvention, let's do that, right? So in my mind, that I think the ability to stitch many different solutions for many different players. And I remember those early conversations, and I think most people said, you're out of your mind, right? You cannot take on the complexity of this. And so not only are we beginning to take on the complexity, and we've seen success across the complexities, but you know where Roopa said, if I don't give her 1 million returnable grants, she's not going to believe it. No one should, right? So the question is, and you know, why the 10 million ambition? Because we're saying, if we can prove the model, if we can do 1 million people who are first to income and first to credit, which is your classic skilling cohort, right? With NSDC moving from a free to a fee-based skilling, who's giving loans to these individuals who are entering the job market, knowing that most 25% of people drop out within the first 1 month? So can you create a mechanism, but do it for 1 million people, right? None of the NBFCs we talk to want to touch micro contractors in the infrastructure sector. You know, largely migrant, God knows what that working capital looks like. If we can prove it for 1 million people in infrastructure, and if we can do it with HDFC and L&T and Godrej and Shapoorji Pallonji, now you've created a sector that IndusInd trusts and HDFC trusts and Kotak trusts at a level of scale. So I think, you know, 2 things, right? One, really using partnerships very creatively and meeting people where they are, whether it's the recipient, whether it's the funder, whether it's the implementation partner, and it's back-breaking work, right? I mean, no one should want to live my life. But it's a fun and exciting life, right? Because at the end of 2 years, you see, you know, lots of innovation happening, right? But then the second is also to do it at a scale because a country needs it. And the only way that the private sector and the government and the financial markets are going to shift is when you give them evidence that's not anecdotal. That's not, oh, you should and you could and, you know, this would be nice to do. I mean, unless there's data behind it, why should anyone trust?
Yeah, and maybe to bring it back to credit-enhanced structures. So does that imply that you see the need for them to play a bridging role as well, continuing to play a bridging role as well?
Yeah, so for sure, right? I think, you know, from the returnable grant, we're doing the pre-credit score. We're not doing the pre-credit score by ourselves, right? We're working with all of our NBFC partners and our bank partners and Kaleidofin and Sibyl and CRISIL. So unless you do it with the industry and unless they trust it, it's not going to happen. Again, I'm not saying believe my pre-credit score. I'm saying I will create that credit guarantee so that the first loan that you give on the back of that pre-credit score is backed by hopefully a philanthropic player. Right? So we're not saying trust us, we're creating the mechanisms that allows the market to shift. And also, we're not just solving the access to credit because you're also, I mean, you know, we're doing everything from market linkages and trade-specific skills, right? So 2 things are happening. One, we are taking away the risk the first time. But second, because the same borrower also gets market linkages and trade-specific skills and, you know, enterprise development support, they're a much better borrower on day 1. They're definitely a very good borrower on day 365 and 10 years from now. So the banks, you know, hopefully should love it. Again, they don't have to trust us, right? So we're running a lot of experiments to say, you tell us what works. If I only do access to credit, what happens? If I do access to credit plus 2 things, plus 6 things, and then, you know, let's figure out what works and what doesn't, right? Which means we need MEL, which is also why I think, you know, investing in that learning and advocacy is so important.
Absolutely. Thanks for that. Moving on to Ravi, maybe. Ravi, you've heard, of course, Roopa and Priya. Would also want to bring you in, again, just given your experience in operating across segments. Are you seeing similar themes in how you would, you know, maybe think about solutioning for some of the challenges that you've encountered? How do we move out of the we saw a lot of innovation, maybe a little bit of stagnation. How we move out of that phase? How do we think about, again, you know, going back to the topic of the conversation, these kinds of structures to actually do that?
Sure. So I completely agree with what Roopa said, right? The banks are not meant to take that kind of risk, right? And it's an NBFC which is on the ground. The bank has a structure which does not really allow it to retail or lend to small bite-sized retail kind of credit, right? So when Priya said that it's a 50x leverage or an 80x leverage, the bank is providing the 50 and the 80. My problem is with the X. That when you say it's a philanthropic organization, or when you say that how many providers of X are there, so that you can leverage it a lot more, right? And how much can you standardize the innovation? innovation for innovation's sake is pointless, right? I mean, why should we have different kind of structures where then, as Roopa mentioned, somebody will take 6 months to understand what is in that structure? Why is securitization such an accepted structure today? Because it is tried and tested to death. Right? Everybody knows how to go about it. The analysis happens within a week's time, and because of priority sector lending, this instrument is now across the board in almost every book. So that is what we should be aiming for. It's not just to innovate to make sure that you can get to small nooks and corners and then carry an article in some magazine and say that this is what we've achieved. But India just needs everything at scale. Right? And scale is not possible unless you standardize. So innovations are happening. I think scaling of that is also happening. My only challenge is that the providers of that X capital are limited. A lot of philanthropic organizations today, a lot of development financial institutions are coming to the fore, but we still see a lot more private players having to participate into this rather than public capital coming in, right? So to just give you an example, right, the European Commission provides a first loss to European funds and accepts a return threshold of 2.75%. This is what I learned today. And the rest of the returns go to the investor. So classically what they're saying is that I am taking a higher risk and I'm getting a lower return. Right? So the extra return that is attributed to me is now going to the senior investors, which improves the risk return equation so well that a senior investor is coming in with a first loss protection and is getting a higher than desired return. So that really aims to, that fund raised $90 million in the pandemic in 2 months from insurance companies, etc. and all. That is the power of what a government entity brings while putting into first loss. Whereas if you see the first loss structures in India, you will see that some of the DFIs are participating in the senior tranche. Right? That's where a bank should be, because bank is not meant to take equity kind of risk. But there are providers of capital that need to take that risk, where some of it is happening. I just don't think it's enough.
Roopa, absolutely, please.
Yeah, so I wanted to also say to the public here that, things are changing very rapidly in banks. While all that we are saying is true, RBI in April 21 signed up with the global central banks for incorporating ESG fundamentals in financial system to make financial systems more robust, which means and about just 2-3 months back they issued I'm working very closely, they've actually formed a sustainable banking department within the Department of Regulations in RBI, and what they are telling to banks and soon to NBFCs is that you have to integrate, because what is the problem here? Access to credit, right? Societal change and environmental change, environmental financing. So climate finance and social finance, 2 aspects of finance you have to integrate in your investment decisions, they're saying. So in IndusInd, we've already integrated ESG risk, it calls. Basically, it says whichever company that you're lending to is not either supporting the environment or not supporting the society, you reduce capital allocation there and increase capital allocation to companies who are either supporting the society, meeting social objectives, or meeting environmental objectives. So the thinking is out there in the, it's not like banks are big bad boys there and, this credit hungry people are just looking here and there for funding. It's not like that. The system is changing drastically. You will see in a few years, sustainable financing is in the front pages of every newspaper that we read today. And if Reserve Bank of India is telling banks, it's already become priority sector for banks, sustainable finance. The problem is understanding. In banks, there are private sector banks, there are foreign banks, there are nationalized banks, and everybody's understanding of this is very vague because it's a new field. So as ESG gets more and more better understood, but it's a question of years only, the adoption will be very fast, and you will see banks just diving into these sectors and transforming it. And I have have seen it happen myself in IndusInd Bank. We are already for in the microfinance business that we are, because we are financing microfinance women. We have close to 85 lakh women borrowers with 25,000 crores of exposures on microfinance. We get cheap capital from development finance agencies, and long-term sustainable equity investors come and finance the bank. We've now started to go just above that chain, and we've started doing lending to Kirana stores, making each Kirana store in the village ATM. So banks are going to transform this as they can see money, because end of the day it's a commercial organization, right? And the rural economy is an extremely profitable and commercially viable economy. As the models there gets tested, and as banks can see that one guy is doing, another guy is doing, NBFCs are doing, you will see money flooding the rural economy, and it will get transformed. I'm sure about that. If not today, maybe in a couple of years.
That is wonderful to hear. And thanks for that. I think it is good to see transformation happening. It is good to know that a lot of the efforts being put in by Priya or Ravi are actually helping transform some of the thinking there. But maybe going to Apoorv for the final word before we open it up for a few questions. Apoorv, I've often heard you talk about how the approach to any of these instruments or any of these approaches needs to be systemic. Are you hearing some of that in what we've discussed here today, and how do you see this actually moving forward from your perspective? But as I know you talk to and of course interact and collaborate with the donor community quite widely. Do you see similar approaches emerging? How do you see this going forward?
Yeah, and I think agree with most of what has been said, and especially what Ravi said. There's dearth of that X. It's not just the dearth of X, it's also how it's being used, right? So, and that goes to your point on how can we use philanthropic capital more systematically, more strategically to really stretch the impact on that dollar. I think we heard that in the last panel, right? So what do you need, right? What will it take to have that microfinance kind of transformation happen in climate mitigation technologies, newer ones, agri, in women-owned enterprises, in water and sanitation, in agroforestry, for example, right? So, and I think that's where that back-breaking partnership really needs to happen among not just donors, but banks, NBFCs, as well as the government, right? So what do you need? You need better, more investable enterprises or individuals. That's where a lot of the work needs to happen, providing business advisory services or, enterprise development services, some Priya touched upon, but really, scaling those accelerator, incubator, whatever programs, right? What else do you need? You need better investor education. I think Roopa is a great champion in her bank, leading all those things. But I think, and I heard this in the first panel as well, I think Arinda mentioned it, till the RMs or people who are originating those deals understand those things as well as Roopa does, I don't think you're going to be able to scale it up to that extent, right? So how do you build that investor education? I think the third one is probably what Ravi says has been solved, tailored financing instruments. And I think that's where, again, somewhat more work needs to happen on, what are grants best used for? Supporting certain innovations to test, scale, coming in as first loss in some cases, coming in for that enterprise development, coming in for, interest subvention, again, depending on what's the challenge, what's the best use of grants. And really, I think Gautam and Abha also reiterated the issue to financing challenge to the instrument approach. I'll add that financing challenge in the middle. And I think lastly, what needs to happen in terms of collaboration is really collaboration with the regulators and government as well, right? Because for MSMEs, for example, how do you solve high dependence on government receivables? Their dependence on government procurement completely, when in some cases payment can be delayed, etc. No one's, NBFCs don't want to touch them. Let's forget banks wanting to touch them, right? So how do you work systematically and collaborate with the government to improve capacity of municipal officials or state government officials, improve procurement practices there, improve structures for investors to invest better. And I think AIF has been a great example of how getting you that flexibility for debt. But, the social venture, the category 1 fund, can you scale up some of those models and really bring that? So I think all these 4 or 5 or 6, things that Priya pointed out need to happen simultaneously or sequentially, but they need to happen in a systematic way. And I think until that does, you'll not see that kind of scale in some of these underserved sectors that we are now seeing in microfinance or utility scale renewable or distributed renewable. And I think that's where, because these are so many different things, that's where everyone can actually play a role. An organization like USAID or other DFIs, multilaterals, can play a role in building, those financial instruments or investing on enterprise capacity development. CSRs can, surprisingly, we found out through Revive and a couple of other things, they can play a role in, enterprise development, returnable grants, and other things like that, right? NBFCs, banks obviously have a role to play in being that lender and really scaling up, investment in these sectors. So I think there's a role for everyone to play. It's not going to be easy to form those back-breaking partnerships, but I think we must try.
No, absolutely. Thanks, Apoorv. And I think a lot of what we're hearing across the table is probably the echoes of what we heard in the previous couple of panels as well, right? When we think about scale, when we think about growth, when we think about how do we really take some of the learnings that we've had here, how can those really be taken forward, and how can alignment happen across not just the development sector, but across the broader economy. So thanks for that. I'll now open this up. I know we have limited time, so maybe for a couple of questions. I see Karthik's hand up.
Just a quick question. Priya, on an ex-ante basis, how do you decide whether to give them a loan, returnable grant, or underwriting the segments for a completely new, fresh risk investor? On a working capital facility, someone asked for an FLDG. How do you know what percentage the FLDG for B? Because you're trying to create that data. You don't know that it's yet 97%. So how do you figure that out?
So I think we do it depending on the trade. It's impossible to do it individual by individual, right? So we have a sense, because now we funded 85,000 retailers, or we've done many farmers or many artisans. Once you understand broadly what the risk profile of their underlying business looks like, I mean, sanitation workers, of course, it's going to be a grant. I'm not going to expect anything else out of them, right? But there's no reason why a retailer or a farmer should not get a loan. So we have a mechanism now to figure out who gets which instrument, but also what is the fastest way to get to the next and the next level. Hypothetically, a woman starting a business can get a returnable grant, but I don't want her to continue getting a returnable grant the second time and the third time. So there's something I need to do with her in the 6 months, as far as her business is concerned, to say the next instrument cannot be the returnable grant.
But how do you quantify the degree of underwriting? So, for instance, if one is, like, let's say, looking to lend 10 crores to micro contractors, right? And hopefully they'll pay back. Now, you don't know how much they'll pay back. So you go to a donor and say, give me a 50% FLDG and I'll figure out the actual repayment rate. How do you quantify initially?
Yeah, so
There's no FLDGs here.
So that's why I think, like Apoorv said, that the co-funding pool was important in the beginning. And what MSDF and Omidyar did at the very beginning of the returnable grant, because no one knew, they actually put together a first loss default guarantee to protect against the default. And we didn't end up using the FLDG. So we actually repurposed the FLDG because we didn't need it anymore. What we also did simultaneously is, because CSRs came in and we have 20 odd companies who are doing returnable grants, is we also built their confidence to say, Godrej, please understand that the underlying business of this beauty entrepreneur is high risky versus, the farmer versus the artisan. And so we also set expectations with the funder itself to say, what can you really expect? Again, we're still finding out, right? Because a bulk of our grants were given during the first, second, third wave. It's only now that you're seeing a sustained period of stability. I think it's something that we're figuring out. But it's a model that we're developing. But we're also asking our NBFC partners the question to say, who would you not lend to and why? Now, I think they will. Yeah. So now we're asking the NBFC partner, what's that 10% segment that you're consistently rejecting? What is the risk premium that you're attaching there that we can now bring in the credit guarantee? So think of Revive as two things, right? Yes, we want to impact the 10 million, but this is also a question of risk discovery for all of us. So it's more a public good. Of course, the 10 million people benefit, but I'm not going to scale to 100 million and whatever else, right? But it's something that helps the banks and the NBFCs and RBI to figure out what's appropriate for what segment.
My question is to Priya and picking on what Ravi said is that India needs everything at scale, and you said 1 million people. Now 1 million people can happen in, let's say, a suburb of Bangalore or in Okla, for example. But when you talk about scale, it has to be across geographies, right? Whether you'll be able to lend to a farmer in Odisha, to a farmer in Himachal Pradesh, to a farmer in Karnataka or Bangalore. How do you make that call, or are you doing all of these?
Revive is pan-India.
Oh, pan. Okay.
So what we don't do is we don't say anybody in 10 million. We say 1 million retailers, 1 million artisans, 1 million in infrastructure, because each segment is different, right? The risk profile of that segment is very different. The stakeholders in that segment are different. So I'll give you an example. We were working with HDFC Capital, and HDFC said, well, the bulk of construction workers and contractors are migrants. And because of ESG criteria, they're saying, hey, I actually want to ensure that my contractors have a few things in place. So now what we're doing is we're talking to HDFC Capital about saying, change your ESG norms and give a discount to L&T and Shapurji and whoever else, provided they do the following. Every worker, every contractor gets money into the bank account, because otherwise, this is informal. Second, everyone gets access to every social security scheme. Third, once the DESH protocol kicks in, every contractor, every worker's experience and education levels have to be documented, and wages have to be pegged against experience levels, right? Fourth, regular safety screenings. Now, what we're hoping to do at the top is also being reflected at the bottom. So now we're saying which NBFCs will help us lend to micro contractors with a credit guarantee. So the contractor does the same 4 or 5 things that I have said in the top. Now, 2 things happen. One, that there is a top-down and bottoms-up incentive, execution plan, etc. If I do it for 1 million, and if L&T and Shapurji and Godrej and whoever get convinced that workers stick around and don't disappear 5 times during the year, contractors improve quality standards, safety is improved. So we incorporate not just social impact metrics, but business metrics for HDFC, for L&T, for the micro contractor, for the worker, for the execution partner. Everyone needs to make money, and everyone needs to be aligned to that incentive. Now, I don't need to do the next 2 million or 3 million or 10 million. Now that industry will function by itself, even if I step out. So the reason for doing the million in each, for doing the 5 million, for doing a lot of the MEL, right, is to say, well, you're shifting policy process. You're shifting how the industry treats its workers and micro entrepreneurs in a way that philanthropy does not have to fund the 1,000,001th person. But the million is important because, like you said, everything needs to be designed for scale from the get-go. Otherwise, you're not seeing. And a lot of these are standardized structures, right? The RG is RG, and 20 people have funded it now in the last few years, and a lot more will fund it. So designing for scale, but also customizing enough that you can truly unlock the scale and address all of the risk barriers that everyone's perceiving at the beginning.
I think she's covered it completely and perfectly.
Wonderful. I think not seeing any other hands up. Okay, there's one more. That's the last one.
This is Sudhir from IP Global, and I will take reference from Abba in the session before this, and Arindam in the morning session, the importance of impact measurement. And so this is where you also talked about a lot on MEL and its importance. So are the banks and DEBS financial partners are ready to pledge resources required for MEL activities as part of this entire structure? That's my question. While it is important, are you?
No.
No, but the good news is there are a whole bunch of other people are. If USAID had not come in with that grant,
Yes.
and if Varad and Abhinav had not held us accountable to the evaluation and learning, this would not have happened. Because for 2 years, ask everybody in the room, all we cared about was getting money in the fastest possible way to that individual.
Yes.
Who cared about collecting data, right? But if these partners had not been around the table, and we hadn't got the understanding for why this was going to be so critical in the short and the long term. I mean, this would all be anecdotal.
Yes.
Right? I mean, last week, Bharat's team asked, it's a very important question, which is what is the percentage of people who got returnable grants who had never taken a loan before, any kind of loan? I hadn't thought about it. But then I had the data, right? And the answer is 58%. Yes. So between 45 to 83% of our borrowers have never taken a loan before. This was the first time that they were taking money, using it and paying it back, right? Now, if that investment had not been made, if we didn't know how to measure it, if we didn't hold ourselves accountable to it, we would not know.
That's what the question that we need to collectively ask. I mean,
So I have two requests, right? And I think, where is the X? Because how can it be three funders? How, right? And these are three funders who are not Indian. So where are the Indian funders who are going to invest in the innovation and the MEL and the creative structures? Because this is for India, with India, by India. And, I keep going into CSR and they're like, but why did USAID fund it? I'm like, because you didn't, right?
That's
I don't say it because I need their check. But, that's the question we have to solve for.
But how did the leverage come?
Oh, the Indians came in, but after we demonstrated.
There was a 58% leverage, right? 58 times or whatever. If everything is grant, how did the leverage come?
Everything is not grant. So let me explain, right? So money that we got, right, was secretariat money, and then we raised programmatic money. So Google came in with almost $2 million, and in interesting ways. So we found that a lot of people that we were lending to, and this was all digital loans, right? There was no physical delivery of cash. So these were women who had never used a cell phone, who had never accepted or paid back, who had never taken a loan, right? And we said, okay, like great repayment rates, but who's teaching them about digital and financial safety and security? If she's handing out her bank account details to whoever, what's going to happen to this woman? And so now Google's come in to say, we will ensure that 900,000 people in the next 1 year get digital and financial safety and security. The second question we were asking is, we're bringing people into the workforce, they're going to quit and then what? Then LinkedIn came in and they said, we will provide mentors so that, you have the ability to find jobs. So the ability to take different kinds of capital, understand the strengths, the weaknesses, the limitations, and then layer on other things consistently in a way that everyone wins. Google doesn't want to do a program. I mean, how are they going to measure digital and financial safety and security if no one has transacted, right? You need information, but you also need transactions. So now everyone wins, right? Because you've customized it in a way that the individual gets a holistic solution, but different partners and different funders provide for different things. But I think my simple thing is that most of our funders today are, yes, a lot of them are Indians, but the cool, the interesting, the MEL stuff is not being funded by the Indian folks, right? And so where are they and what can we do collectively as a community to bring them into the room and believe that, this is vital, right? How does a country grow otherwise?
Yeah, wonderful. Lots of great questions, and thanks for that. Thank you very much to the panel. I think some really interesting insights, and again, not summarizing all of the interesting ideas that came up, but feel like this is a good beginning. Roopa, you put it really well that the transformation is ongoing, and I think all the efforts of everyone in the room and many others that have been referred here are helping with the transformation. So thank you everyone. Thank you everyone for the questions, and yeah, I think with that we can close.